Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Roivant Sciences Ltd. Quarterly Report. Roivant Sciences Ltd. is a clinical-stage biopharmaceutical company that focuses on developing innovative medicines and technologies. The company's pipeline includes several promising product candidates, each targeting specific indications. These include IMVT-1402, a fully human monoclonal antibody for the treatment of various autoimmune diseases such as Graves' disease, rheumatoid arthritis, and lupus erythematosus. Batoclimab, a fully human monoclonal antibody for thyroid eye disease. Brepocitinib, a small molecule inhibitor of TIE-KATE-WO and YA-cone for the treatment of immune-mediated diseases like dermatomyositis and uveitis. In addition to its product candidates, Roivant Sciences Ltd. also offers delivery platforms that enable efficient and targeted drug delivery. These include lipid nanoparticle (LNP) platform, which allows for the encapsulation and delivery of therapeutic molecules. Ligand conjugate platform, which enables the attachment of targeting ligands to therapeutic molecules. The company's lead program is focused on mosliciguat, an inhaled SGC activator for the treatment of pulmonary hypertension associated with interstitial lung disease. With a strong pipeline and innovative technologies, Roivant Sciences Ltd. is poised to make significant contributions to the field of biopharmaceuticals. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to skyrocket. The stock price of Roivant Sciences Ltd. has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying reasons for this trend. One possible explanation is the company's innovative approach to drug development, which has led to several promising pipeline candidates. Roivant's unique business model, which involves creating multiple subsidiaries focused on specific therapeutic areas, may also be contributing to its success. Another factor that could be driving the stock price upward is the growing interest in biotech companies, with a strong focus on research and development. As the pharmaceutical industry continues to evolve, investors are increasingly looking for companies that can bring new treatments and therapies to market quickly and efficiently. Roivant's commitment to innovation and its ability to attract top talent may be resonating with these investors. Additionally, partnerships and collaborations with other major players in the biotech industry could also be contributing to Roivant's success. The company has been actively seeking out partnerships that can help accelerate its pipeline candidates and expand its reach into new markets. These partnerships can provide a significant boost to a company's stock price, as they demonstrate the confidence of other industry leaders in the company's prospects. Overall, it is likely that a combination of these factors has contributed to Roivant Sciences Ltd.'s skyrocketing stock price over the past year. As the biotech industry continues to evolve and new treatments are developed, investors will be closely watching the company's progress and looking for opportunities to invest in its future growth. Roivant Sciences Ltd. market capitalization of $18 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Roivant Sciences Ltd. holds a significant advantage in their industry. Roivant Sciences Ltd. trades at a higher price-to-book ratio of 4.29 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 5% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline are multifaceted, encompassing regulatory, market, supply chain, intellectual property, and financial aspects. Regulatory changes, such as healthcare laws and compliance with applicable regulations, can significantly impact revenue. Companies must navigate complex regulatory landscapes to avoid penalties, fines, and reputational damage. Market competition is another crucial factor, with numerous players vying for market share. The development of competing products by large pharmaceutical and biotechnology companies can erode a company's market position and revenue. Supply chain disruptions, manufacturing problems, and equipment malfunctions can also hinder revenue growth. Intellectual property and data security concerns, such as product liability claims and regulatory sanctions, can further impact revenue. Financial and capital markets factors, including sales of common shares by the company or large shareholders, negative evaluations from securities analysts, and changes in analyst recommendations, can also influence investor perception and revenue growth. Ultimately, companies must carefully manage these various drivers to achieve sustained revenue growth and mitigate potential decline. The net income of a company has experienced a decline over time. Initially, on page 58, it was reported that the net income decreased significantly due to substantial losses and negative cash flows from operations, resulting in an accumulated deficit of $695 million. This downward trend continued as mentioned on page 85, where the decrease in net income was attributed to increased manufacturer rebate liability, a broader scope of products subject to Medicaid rebates, and stricter drug pricing practices. The impact of these factors is likely to have also affected profit margins, although specific information is not provided. However, it can be inferred that profit margins may have decreased due to lower reimbursement for Medicare Part B utilization and new reporting obligations. The company's debt level has not shown any significant changes throughout the year. Despite some minor fluctuations and errors in reporting, the overall trend indicates that the debt level remains relatively stable. However, this stability is overshadowed by a notable increase in interest expenses. Interest expenses have seen a substantial rise due to various factors such as increased borrowing costs and losses on extinguishment of debt. The significant jump in interest expense is evident from the financial reports, which show a considerable increase in interest payments over the past year. This trend suggests that the company's financial obligations are becoming more burdensome, leading to higher interest expenses. In conclusion, while the debt level remains relatively unchanged, the increasing interest expenses pose a concern for the company's financial health. The significant rise in interest payments may indicate a need for the company to reassess its borrowing strategies and explore ways to mitigate these costs. The company's outlook is uncertain due to various risks and challenges. Management highlights significant regulatory risks, particularly in data protection laws, patent protection, and trade secrets. The intense competition from established companies with greater resources and capabilities poses a threat to the business. Intellectual property rights are crucial for the company's success, but the patent portfolio may not provide sufficient protection. Changes in tax laws or interpretations by tax authorities could increase the consolidated tax liability and affect financial condition, results of operations, and cash flows. Management also emphasizes the importance of human capital management, including retention of key personnel and attracting high-quality personnel to discover and develop product candidates. The company faces risks related to international operations, conflicting laws and regulations, obtaining licenses and approvals, and managing operations in different jurisdictions. Overall, the company's strategy appears to focus on navigating these challenges by maintaining a strong patent portfolio, adapting to changes in tax laws and regulatory requirements, and investing in human capital management. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has purchased IMVT-1402 and Bataclimab through the Hanal Agreement, invested in Datavant with an estimated fair value of $247,051 as of December 31, 2025, and entered into a business combination without providing specific details. The divestitures made by the company include the sale of its entire equity interest in Dermavant to Organon in October 2024. This transaction was part of a strategic partnership known as the Dermavant transaction. The sale resulted in the company no longer holding subsidiary interests in Dermavant, marking a significant shift in its business operations. The acquisitions and divestitures made by the company demonstrate its efforts to expand its portfolio and streamline its operations. By investing in new assets and partnerships, the company aims to drive growth and innovation, while also optimizing its resources through strategic divestments. The company's financial strategy has been focused on share buybacks rather than dividend payments. According to the company's common share repurchase program, a total of up to $500 million has been authorized for this purpose by the board of directors. This indicates that the company is prioritizing the reduction of its outstanding shares over distributing profits to shareholders through dividends. That concludes the financial summary for Roivant Sciences Ltd. Feel free to comment below, and I will be happy to answer them when possible.